Good morning. It's Jeffrey Christian from CPM Group, November 20th, about 10:20 or so in the morning. Gold prices this morning, once again, we're testing 1860. They've been testing 1850, 1860, which is a big technical support level for the last several days. And really, actually, since late September, they've tested it several times and bounced off of that. That's important for a variety of reasons. One is that 95% of the trades on the COMEX probably are technically driven, many of them generated by computers that look at price momentums and technical chart patterns. You can see from the chart here that level has really held since the price spiked up to $2,090 on August 7th, and then came down $217 in the subsequent 4 trading days. And the 1850, 1860 has been a support level. It is important because not only are the COMEX futures and options trades based on these chart patterns, but so are a lot of forward trades. We've seen investors selling some of their gold ETFs over the last few days and the last week or so, partly out of optimism. Oh, there's vaccines coming. The election is behind us, but maybe it's not. There'll be a stimulus program. Maybe politics will improve both in terms of national politics in the United States and global politics internationally. Maybe there'll be some sort of thaw between China and the United States. So there's been some optimism. We think it's a little bit misplaced. I'll get back to that in a second. And that has caused the price to be testing this level. If the price breaks below it, the price of gold could drop sharply on a short-term basis, I believe. There are technical support levels at 1780, 1750, 1700, 1680, 1650. 1650 is a $200 drop from where we are, where this floor is, and that seems big. But again, go back to that July and August period. August was an active traded month on the COMEX. You had more than 40 million ounces of open interest in the August contract, and it had to be rolled forward into December if the shorts didn't want to deliver it. So over the course of late July, those shorts were buying back their August contracts and selling into December futures. You saw that reflected in that sharp increase in the price. On August 7th, the August roll was largely behind the market. That price support disappeared, and the price came down to $217 in 4 trading days. We're not saying that that's going to happen again, but what we're saying is it's possible. And recent history shows that it's possible. Now, if you look at December and you go back to early November, you probably had about 44 million ounces of open interest in the COMEX December futures contract. About half of that has rolled into the February contract, the next active futures contract. You've got about 22 million ounces of December open interest still to be rolled forward, and about 22 million ounces that has shown up in the February contract. That could support the gold price for the next 2 weeks until around December 7th or so, maybe earlier. Typically, the shorts roll out before the first delivery date, which is going to be the last trading day of November, Monday the 30th of November. And given that next Thursday is a holiday in the United States, you might see that will go faster. Or it might roll into early August, which has early December, which has happened. It happened in the August contract. So that might support the price, but you might see some selling before that. Our view is that the gold price is still likely to rise, at least in the intermediate and long-term basis. We've talked about the big 3 factors that have been stimulative of investment demand for gold. Investment demand for gold this year is more than double what it was last year. You have the pandemic, you have the economic recession on a global basis, and all of the economic and financial problems that relate to that. And then you have politics. And the politics, while the election is behind us in the United States, it hasn't been resolved. And the Trump campaign is working very hard to try to manipulate the Electoral College and the state legislators and the court system to take the election away from Joe Biden. You also have a runoff in the Senate, which isn't going to be until early January. So there's still an unsettled domestic political environment. And we've seen the same sort of market on way this week that we saw in the period immediately after the election while everybody waited 4 or 5 days for the results. So we think that from a longer term perspective, and by longer term, I mean January, the first quarter of this year, the next year, the next 2 years, the next 10 years, from an intermediate term to long-term view, we're still optimistic that the gold price is going to rise because we are very pessimistic about the state of the world. There is a rise in optimism. Oh, yes, we have a vaccine. Politics are behind us, the economy, there'll be another stimulus program because you have Democrats in the White House. We think that a lot of that optimism may be premature or maybe misplaced. Misplaced might not be the right word. In terms of the vaccines, it's going to take months for those things to be distributed broadly enough, at least in the United States and Europe, to really start having a positive effect in terms of immunizing the herd, if you will, the population at large. The vaccines are still a couple months away from being distributed initially on a limited basis to people who really need it. Meanwhile, the pandemic is getting worse in the United States and Europe, and we're moving towards shutdowns in those two major economic engines of the world. So the pandemic is still a problem. The vaccines are months away. We think that the optimism is a little bit premature. Again, the election is still unsettled, and I think it's problematic. And we keep talking about Brexit, and people keep ignoring it. But Brexit could really be a problem. You also have the roll away from LIBOR to something other than LIBOR, which is causing a lot of consternation and concerns in the financial market. This morning, you had the Treasury say that it wanted $455 billion back from the Fed of money that had been allocated to emergency lending programs that hasn't been actually lent out. In other words, the Treasury is saying, screw you, America, we're taking that money back. So we don't think that the economic and financial situation is ready to be resolved. We think that any stimulus program is going to have to wait until after January 21st. And we don't think the political situation is quite as optimistic as some people seem to think it is, at least in the immediate future and probably in the long run too. So our expectation and our advice to our investor clients is you probably still want to be long gold, but you probably also want to buy some puts or some compound option strategies to buy yourself some insurance against the short-term price decline. Now, it's not just insurance. This is insurance with benefits. You buy puts or you buy a compound option that somebody like CPM Group structures for you. And let's say the gold price drops $100 or $200. You sell those puts back. You make $100 or $200 an ounce. Maybe less, depending on the volatility and the time decay in those options programs, but you can make a substantial amount of money. So let's say that you're an investor, you're interested in gold, you've been buying gold, gold price is $18.50, you buy some gold at $18.50, you spend some, maybe another $80 or so on some options. Price falls, those options that you spent $80 on are now worth $160. You make $80, your net effective acquisition price has just been reduced by the profit that you made on your puts. So that's sort of our view for investors and for producers. Producers don't hedge for a variety of reasons. We're actually talking to various companies about that right now, but the producers could do that too. The producers have seen their share prices hammered very sharply over the last couple of months as the gold price came off of that high. There are any number of people who will assure you that the gold price can only rise. But there are any number of people who look at a price chart and say, actually, the price of gold rises and falls all the time. And maybe the optimism about gold prices and the pessimism about the imminent collapse of the global financial system is as misplaced as it was in the 1980s, 1990s, aughties, 2000 teens. So it may be a good time to buy some insurance. That's about all I have for now. We'll probably do something next Wednesday because next Thursday is Thanksgiving in the United States, and next Friday is the day after Thanksgiving at CPM Group. While we usually follow the CME calendar, which has trading on that Friday, we do take that exception, and we give ourselves that Friday off to go jog and wear off some of the Thanksgiving meal. So we might do another video next Wednesday. If it's not next Wednesday, it's going to be the following Monday. In the meantime, take care, be safe, and take care of other people. Thank you.